Hey everyone, we're going to get started today. Thank you so much for being here. My name is Sujata Shyam, and I am the managing principal of Lux Capital. And this is our Masterclass Series, how to get started as a passive investor, all without needing any real estate experience. And so the whole goal of this series, we're here for you to help you feel comfortable and informed and capable of making good decisions for your own finances and for your own investing portfolio. So here we are. Are you ready to learn the biggest two myths that investors have regarding syndication investing? If that's you, we're here for you. We're going to also learn about what is the crux of actually just letting a few people in. What is the crux of actually how we actually make money in real estate? And that's the focus for today. But for now, let's get started on the two biggest myths that investors tell themselves when they are investing in syndications. The first one is, I have no control. And it's true, these are passive investments. However, this mindset keeps many investors sidelined from ever beginning investing in syndications. And so, why do you have control? Well, the main control that you have is selecting the deal. So, is it in a market that you like? Is it a property that you think has the potential to actually increase in net operating income? Is the market in a favorable market with strong demographic trends and strong job trends, et cetera? And then the main thing that you have control over is selecting the sponsor. Is the sponsor capable of executing the business plan? Do you trust the sponsor? Does the sponsor have a track record? And you have a tremendous amount of control when it comes to where you put your dollars. And then you hand over the reins to the person that you have entrusted, and they shepherd the deal. And at that point, you are a hands-off investor, and you have the benefit of not actually having to deal with tenants and toilets and termites, etc. So the main control that you have is when you're selecting where to actually place your dollars. And you have quite a lot of control in that realm. There are a lot of deals out there, and there are a lot of sponsors out there, and you have a lot of control with where you place your dollars. Okay, the next biggest myth that investors tell themselves about syndication investing: I won't make that high of a return. Again, this mindset keeps many investors sidelined from investing in real estate. But I want to ask you, compared to what? Compared to what? Because what kind of return would you make if you're investing in the stock market? Also, what kind of investment return would you make if you're doing your own investment portfolio and actually managing the properties yourselves? Because you want to make sure you're valuing your time, right? Like, you can't just count return on investment. You also got to count your return on time. How much time are you putting into these deals? And with syndications, one of the main benefits is that it's hands off. You don't actually have to invest your time into making sure that the day-to-day operations of the property are going well. You don't actually have to execute a major remodel or a large construction plan or even a ground up construction. You literally get somebody else get their hands dirty and do that work for you. So I won't make that high of a return. I always want you to remember to ask yourself, compared to what? Okay, so I'm Sujata Shyam. My story is that I have a long history in syndications. I began underwriting for institutional equity partners in 2010, underwriting multifamily investments. So I have a long history in this space. And I eventually set out on my own. I built my own real estate portfolio, which is how I replaced my corporate income. And now I take the profits from that portfolio and I put them into private placements, just like the ones that my firm offers, and all of the ones that my firm offers, in fact. And I invite other people to participate alongside me. One of my main reasons for doing this is I personally just didn't thrive in an environment where I had to be accountable to a particular schedule, where I had to be in the office 8 to 6 or whatever the requirements were at the time. I had to I was in jobs where I'd have to put my evenings on hold because we had a deal closing. And I just didn't really want to be subject to somebody else's schedule. I wanted to be able to have work-life balance, and I wasn't able to do that in the career that I had chosen. And frankly, I think a lot of people aren't necessarily able to do that in their careers. And so that's why I needed to set out on my own and carve my own path. And that's why I got into real estate syndication investing. This is a picture of me and my partner, Ben. We went to the Grand Canyon this summer for a month-long trip down the Grand Canyon. It's the second time we've done it. And this kind of trip is a huge reason why I'm so grateful that I get to do this work, that I get to invest in real estate, that I get to help other people invest in real estate and create a life where they too potentially can go on a month-long trip whenever they want, or make that happen within their lives. And so that's one of my main whys, is to have that personal freedom. And so fast forward to a couple years since I opened the private equity firm, we now have 37 properties in our portfolio, over 1,850 self-storage units, total portfolio value of 132 million plus. And that's going to be changing as we close more deals this month. So a lot has happened in the last 2 years. We have over 250 verified investors and over 40% repeat investors, which is really a huge, huge thing that I'm proud of, because I really want to provide my investors with such a good experience that they really trust and love and want to come back. And so that's really big for me. And here's just some pictures from the last year, doing due diligence, starting my podcast, visiting sites of projects that we've invested in, self-storage sites, visiting ground up sites of projects that we are currently investing in. And that's just to give you some pictures. And what's coming next? We're doing this masterclass series for you to help you feel comfortable investing in real estate and investing in syndications. I know it's a whole new language to learn, and it's a whole new world to kind of figure out who the players are and where you want to invest your money, who you want to trust, what kind of deals you want to do. There really is a lot to understand. And so I'm here to help you feel more comfortable and confident as an investor. And so to that end, we have several different topics that we're going to be covering. Some of these we've already covered already, like we covered the 4 tenets of conservative investing, this 3 secrets to control. And today we're going to talk about the crux of understanding how we create value in multifamily investments, which is something that I'm very excited about. And before we get started, just a disclaimer, this is for educational purposes only. We're not a legal, financial, or tax advisory firm, so please consult with your own people. That said, please bring any questions you want to me, and I will be happy to answer them up until the point when I can no longer answer them, and then I'll let you know. So please don't be shy with questions. So the crux, how do we increase the equity in a property? So for those of you who are analytical types, you will want to understand the math behind the money, and that's what we're here to do today. So last week we covered the 5 ways that we make money in real estate syndication deals. And just to review that very quickly, we talked about cash flow, which is when we get cash flow from the properties. And the cash flow is what is left over after we pay our operating expenses, after we pay our mortgage expenses, and we can distribute that to our investors. And that's one way that you make money in real estate. The other way is leverage. So we're able to use leverage to increase our return on equity. And I won't go into any more detail than that now, but it's one of the major reasons that people invest in real estate. Number 3 is equity growth. So we are able to force appreciation and grow our equity in the property through increasing the NOI, or net operating income, of the property. And that's what we're going to talk about today. We're going to focus on number 3. Just to finish out this list, number 4, tax benefits. Another major reason why people invest in real estate is because of the amazing tax benefits that it provides, that frankly, we just don't get in other asset classes like stocks, bonds, et cetera. And number 5, appreciation. This is kind of the icing on the cake. If you happen to invest in a market where that is getting hotter and cap rates are compressing, then we We'll also be able to capture market appreciation, not just forced appreciation. Okay, so now we're going to talk about number 3, and we're going to do a deep dive into that so that everyone gets really clear on just exactly how we create value, how we build equity in these properties. So first, we're going to talk about some important terms that you may or may not yet be familiar with. If this is review for you, I hope you can glean some piece of information that's helpful to you. If it's brand new to you, then you're in the right place as well. So net operating income equals income minus expenses. And we're going to dive into that a little bit. But the other term that we need to understand today is cap rate. And cap rate is the annual net operating income divided by the purchase price. So that's just a basic overview. Now we're going to talk a little bit more in depth about net operating income. So how do we actually calculate net operating income? So with net operating income, we are going to first calculate our income. And so income is going to include rent per unit. And then we're also going to add in and then that will equal the gross potential income. And then we're going to subtract any vacancy, bad debt, any delinquency, and that will give us our total income. I'm just going to clear out some of these things here so that it's a little bit more clear. So this is how we get our total income is we take the rent per unit and then we subtract out vacancy, bad debt and delinquency. We add in other income, and that is how we get our total income. So basically it's the rents collected from the property and any other income streams like laundry, parking, late fees, etc. So for the expenses at the property, here are just some examples of expenses that we are, and this is like a pretty basic list. So payroll, utilities, electricity, water and sewer, trash, other utilities. And then TO stands for turnover. So it's a cost that we incur when a tenant moves out and we're going to move a new tenant and we have to turn over the unit. And so we're painting and maybe redoing the floors or some repairs, et cetera. So turnover costs are an important one. Maintenance, admin and marketing, management fee, and any other management fees, like if there's a lease renewal fee, et cetera. Yeah, and then we're going to put in a deposit to a reserve. That's very important because we want to make sure that we are reserving for capital expenditures that we're going to incur. So if we have a large expense later on down the line, we want to make sure we have money in reserves. And we're also going to include property taxes and insurance in the expenses. So total expenses include all that type of stuff. So income minus expenses equals net operating income, also called NOI. Very important that we get familiar with these terms because you're going to be hearing them a lot and it'll really help you feel comfortable and confident when you're looking through investment summaries. Okay, so what is not included in net operating income? The main thing in a real estate transaction that's not included is your loan payment or your mortgage payment. And why is that not included? It's not included because different buyers are going to use different types of financing. For example, one buyer might have really great credit and a lot of relationships, a big relationship with their lender, and they might be able to get a low interest rate on a 40-year amortization schedule, for example, whereas somebody else might, need to have a higher interest rate because they don't have maybe as deep of pockets or as good of a key principal who's helping them kind of shore up their profile as a borrower. And so they might have a higher interest rate and a shorter amortization period, just for example. Or maybe a buyer is going to buy all cash and they're not going to use any loan payments at all. Or maybe a buyer is going to use seller financing and then they're going to have a higher interest rate or something like that. So there's all these different types of financing. I mean, I only mentioned just like a few out of dozens of types of financing that people could use. So we want to take that out because if you're looking to buy a property and you're like, okay, I think I want to buy a property that has with this kind of financing, and I'm going to say, I'm looking at the same property and I want to buy it, but I want to pay all cash. The brokers need to be able to show us what the property, how the property is performing independent of how we plan to finance the property. And so that is why we do not include loan payments when we're looking at the cap rate. So it allows us to make these apples to apples comparisons. And so that brings me to cap rate, which is the next thing that we're going to go over because it's related. So cap rate. So what is a cap rate? This is something that, is important for you to wrap your mind around, and you'll probably continue to sort of gain insights into what the cap rate is and how it functions and what kind of issues you need to look out for when you're considering cap rate. But for right now, let's talk about what it is. The definition is net operating income divided by purchase price. So what does that mean? Let's say we have a property that produces net operating income, or income minus expenses, of $50,000 a year. And the purchase price is $1 million a year, and it sells. It just sold last week for $1 million. So in that case, the cap rate is 5% because we take $50,000 and we divide it by $1 million and we get 5%. That's a pretty, typical cap rate that you may see in a decent market for an apartment building. So let's say, however, that this property was located in a less desirable market, maybe a rural area that's not an urban center. Maybe it doesn't have a large employment center. Maybe people are not necessarily moving to that city. So let's say property is in a less desirable market. We're just going to take the same exact property with the same operations and transplant it to a different market that's less desirable. In this market, the cap rate is 7%. So in general, people are willing to pay less for the same income stream because they view that income stream as riskier than they would view it as if it was in, say, a major city. Oftentimes major cities are viewed as more stable because, there's always people moving to them, at least in recent years. So let's say the cap rate is 7%. So how do we determine what the purchase price is? Well, let's take that formula. Cap rate equals net operating income divided by purchase price. And now, if you remember high school algebra, we're going to move some things around. We're going to move the purchase price over here. So we're going to multiply purchase price, and then we're going to divide by the cap rate. And so now we have purchase price equals net operating income divided by the cap rate. So in this case, we had net operating income of $50,000 per year and a cap rate. The cap rate is now 7%. So the purchase price equals $50,000 divided by 7%. And so in this less desirable market, the purchase price is going to be $714,000. So that's how we know how to price the property. And if you're the same exact property would command a lower price in a less desirable market. That makes sense, right? So that is something to keep in mind when you are looking at deals, that the cap rate is also moving. So if a market is getting hotter, then cap rates are compressing. That means that cap rates are going down. So if the markets are getting less hot or less desirable, then the cap rates are going to expand or go up. And you'll hear those words: cap rate compression, cap rate expansion. And that's what it means. As if there is cap rate compression, it means that more and more buyers are flocking to that market and people are willing to pay more for the same income stream. And on the other side, if people are saying, no, I don't really want to invest in that neighborhood or that city, then the cap rates may be expanding and people are willing to pay less for the same income stream. So that is, they're moving as cap rates are moving as markets shift in terms of their desirability and, what people think of them. Okay, so now let's talk about one of my favorite topics, which is the value of a dollar in syndications. Okay, this is such a powerful concept. So what happens, let's take the same property. What if we're able to increase the NOI or net operating income by just $1 a month? The entire net operating income of the entire property goes from, if it was $1 a month, then it would go from 50,000 to 50,012 over annually. So we take $1 a month and we multiply it by 12 months and we get $12. Okay, so now we're going to apply the cap rate. And that means we're going to say $12 divided by 5%. And that equals $240. And if we just do the math, 50,012 divided by 0.05, we do get $1,240,000. You can do it with me on your calculator if you want, just to make sure you're understanding it and really grasping it yourself. So we increased the value of this property by $240 just by increasing the NOI by $1 a month. Can you believe that? We took $1 and we converted it into $240 of value just by the fact of having this dollar come out of in a commercial real estate scenario. So that, and to me, that multiple of 240x, you add $1 of NOI to any property, and that means that you've now earned yourself $240 is just so powerful. So let's extrapolate that and talk about why we as sponsors go looking for dollars. Like we literally go scour the property and say, where can we get more dollars of NOI per month? And we get a little bit here, we get a little bit there, we get a little bit here, and it all adds up. And if we can create a business plan where we're able to do that, it's pretty straightforward. It's a pretty straightforward business plan. That doesn't mean it's easy to execute, but it's a pretty straightforward business plan. So let's just say this was a 10-unit building, and we're going to implement a renovation plan. So the units are old. It's like maybe say 1980 building. So it's over 30 years old and the units are ready to be renovated. So we're going to renovate the units, and that will allow us to increase rents by $150. And we know that because we've done that in previous apartment buildings in the same market. And we know what kind of rents these upgrades will command. And that's another thing. You want to make sure that you have a really good sense of what these units will go for. So you need to have either boots on the ground, a great property management team who knows what the going rate is for these types of properties. And you also want to make sure you know how much it's going to cost for you to upgrade those units. And so let's say that we know that we are confident that we can increase the rents by $150 if we renovate them: new kitchens, new bathroom, new flooring, etc. And, maybe some upgrades to the common areas as well. Let's say that the total cost to us is $13,000 a unit or $130,000. So it costs us $130,000 to carry out this business plan. And so that's going to be the cost to us, and we're going to factor that in at the end. So we just increase rents by $150, over the course of 1 to 2 years. And let's take that $150 and multiply it by 10 units. Oh, this should be 10 units. And then multiply that by 12 months. And that equals $18,000. So again, we're going to apply the cap rate. Feel free to do this with me on your phone calculator or your Excel, because it's really important that you do it yourself and start to understand it. So $18,000, we're going to apply the cap rate of 5%, and we get $360,000. $360,000 is how much we have increased the value by, because we are going to find a buyer who doesn't want to do the heavy lifting. We're doing the heavy lifting. We're renovating the units. We're finding contractors. We're executing this business plan and getting the property to a point where it's optimized. And then we're going to sell it to somebody who just wants to get a steady cash flow, and perhaps they, maybe they want to get the tax benefits. Maybe they need to place capital. Maybe they're an insurance company and they have money that they need to place. There's a whole host of buyers that want to buy stabilized, cash flowing properties. So $360,000 is what we increased the value from. Remember, we bought this property for $1 million. And now we've increased the value to $1,360,000, which is a lot. Of course, we spent $130,000 to carry out that business plan. So we're going to subtract 130 and we get $230,000. So that is pretty amazing. $230,000 is almost $250,000, which is a quarter of the value of the property, but it's actually even more than the equity that we put into the property. Because let's say that we needed to put in $250,000 for a down payment, and we also, let's add $130,000 for the renovation costs. And there's other costs I'm not including in here, but let's just say the all-in equity was around, let's just say $450,000. So $450,000, we just increased the value of the property by $230,000. So $450,000 divided by $230,000 equals 1.95. So we almost doubled our money in terms of return on equity. So I think that's super powerful. Just by simply executing this business plan and renovating the units and increasing the rents by $150, we're able to double our money. So, $150 is kind of a large increase. It's actually a pretty big increase, but let's just take a smaller example. Okay. So what if we were able to cut the water bill, which we're paying for? Let's say as landlords, we're paying for the water bill. And we're able to cut it by $10 a month per unit by installing low flow shower heads, low flow faucets, low flow toilets, etc. There are certain ways that you can definitely lower the water bill. And let's just say we're able to lower it by $10 a month per unit. So $10 a month times 10 units times 12 months equals $1,200. Again, you apply the cap rate, and $1,200 divided by 0.05 equals $24,000. So even just there, we have increased the value of the property by $24,000 just by implementing a water saving program. And so that's what we mean when we say we're going and looking for dollars around the property. There's other ways of doing this. For example, I started this list, we add washers and dryers. That is a easy way to charge $50 to $75 more per unit. I mean, that is a standard increase in rents when you can add washer dryers. So you can add reserved parking, for example. People like to know what spot they're going to have. You can add reserved parking. People will pay for that. You can add valet trash. There are a lot of ways to just incrementally, I mean, we can do more savings, like we can implement electricity savings. We can add internet, and there's a lot of different ways. We're going to go over a comprehensive list sometime about how we can do that. But this overall segment is to explain how we get to equity growth. And so that is how we do it. So back to the 5 ways to make money. We just focused on equity growth, and the value of $1, we can turn every dollar per month into $240 of value. And that's the main concept. So thank you so much for coming. I want to see at this point if anybody has any questions.